What if you were given $10,000 right now? For one person, it could be the start of a small fortune. For another, it could vanish in a few bad decisions. The difference isn't secret knowledge, it's a set of rules. We're going to break down the 15 rules that separate disciplined, wealthy investors from those who go broke, chasing hype. Building wealth in the stock market isn't about getting rich overnight. That's gambling. True investing is a long-term game won by having a solid playbook. The stories you see about people striking it rich on meme stocks are the exception, not the rule, and they often leave out the devastating losses. This video is your playbook. We're going to give you the 15 essential rules for investing. By the end, you'll have a framework that can help you build real, lasting wealth and avoid the flash-in-the-pan wins that so often lead to heartbreaking losses. Rule number 1. Invest only what you can afford to lose. This is the foundation of smart investing. It means you should have your financial house in order first, specifically an emergency fund to cover unexpected expenses. The money you invest should be capital you won't need in the short term so you can make decisions based on strategy, not fear, without losing sleep. Rule number 2. Don't buy all at once. Dollar cost average, DCA. This means investing a fixed amount of money at regular intervals, regardless of what the market is doing. For example, instead of putting your entire $10,000 into the market at once, you could invest $2,500 each month for 4 months. This strategy reduces the risk of buying everything at a market high and averages out your purchase price over time. Rule number 3. Avoid FOMO, fear of missing out. FOMO is a purely emotional reaction. It's the urge to buy a stock after it has already shot up 30% because of social media chatter. You jump in because you can't stand being left behind. This often means you're buying at the peak, just as the early smart money is getting out. Resisting FOMO is critical for avoiding bad entry points. Rule number 4. Take profits when appropriate. If an investment has a significant run-up, it's wise to lock in some of those gains. For example, if a single stock holding doubles and now makes up a huge portion of your portfolio, you might sell a percentage of it. This rebalances your portfolio and turns paper gains into real money. Letting greed take over and holding on in the hopes of infinite gains is a dangerous game. Rule number 5. Diversify your portfolio. This is the classic rule of not putting all your eggs in one basket. Instead of betting your entire $10,000 on one company, you can spread it across hundreds or even thousands of companies through a broad market index fund, like an S&P 500 ETF. If one company performs poorly, it won't sink your entire portfolio. Rule number 6. Keep emotion out of investing. Fear and greed are your two biggest enemies as an investor. When the market drops, fear tells you to sell everything. When a stock is soaring, greed tells you to pour more money in. A successful investor acknowledges these emotions but doesn't act on them. They stick to their predefined plan instead. Rule number 7. Do your research. Proper research isn't about finding blog posts that confirm what you want to believe. It's about understanding what you are buying. For an index fund, it might mean knowing its long-term historical returns and expense ratio. For a single stock, it means analyzing the company's financials, leadership, and competitive advantage, not just the hype surrounding it. Rule number 8. Be patient. Wealth is built over years, not days. Investing is a long-term endeavor, and patience is required. Trying to rush the process by making high-risk bets to recover a loss or speed up gains is a recipe for disaster. Compounding needs time to work its magic. Rule number 9. Expect and embrace market corrections. The market does not only go up. Drops of 10 to 20%, known as corrections, are normal, healthy, and happen regularly. A prepared investor sees these corrections not as a crisis, but as a sale. It's an opportunity to buy quality assets at a lower price. An unprepared investor sees them as a reason to panic. Rule number 10. Always keep some cash, dry powder. Having cash on the sidelines is a strategic advantage. When the market correction you expected finally happens, this dry powder allows you to buy assets at a discount. If you are always 100% invested, you can't take advantage of the best buying opportunities that fear in the market creates. Call to action. If this rule-based approach is starting to make sense, hit that subscribe button. Learning to invest with a plan is the key to building wealth that actually lasts. We're about to see how all these rules come together to protect you from the most common mistakes. Rule number 11. Cut your losses when needed. This rule is often misunderstood. It doesn't mean panic selling at the first sign of a drop. It means reevaluating why you bought an investment. If the fundamental reasons for owning it have changed for the worse, it may be time to sell and move on, even at a loss, to prevent a small loss from becoming a catastrophic one. It's a strategic decision, not an emotional one. Rule number 12. Ignore hype. Hype is temporary and driven by stories, not fundamentals. By the time a game-changing stock is all over the news and social media, the biggest gains have likely already been made. Disciplined investors focus on the underlying value and long-term potential of an asset, not its popularity at the moment. Rule number 13. Focus on moats. A moat is a company's sustainable competitive advantage that protects it from rivals, just like a moat protects a castle. Examples include strong brand power like Apple's, a low-cost production model, or network effects. Investing in companies with wide moats provides resilience and long-term staying power for your portfolio. Rule number 14. Find your own strategy. There is no single best strategy for everyone. Simply copying what anonymous accounts online are doing is not a plan. Your ideal strategy depends on your age, risk tolerance, and financial goals. Whether it's simple index fund investing, dividend investing, or another method, the best strategy is the one you understand and can stick with, especially when the market gets tough. Rule number 15. Have a plan and stick to it. This is the rule that unites all the others. A plan is a simple set of rules you define for yourself before you invest a single dollar. For example, I will invest $500 a month into an S&P 500 ETF and will not sell for 20 years. This plan dictates your actions, keeping your emotions on the sidelines and guiding you from one smart decision to the next. Conclusion and reveal. So what is the result of applying these rules over 1 year? An investor who ignores them, buys a single hyped stock at the peak, and panic sells during a downturn could easily turn $10,000 into $4,000, a 60% loss that also shatters their confidence. An investor who follows the rules could tell a much better story. By using a disciplined, emotion-free plan like dollar-cost averaging into a diversified fund, they use market dips to their advantage. That same $10,000 investment could easily become $11,500, a solid 15% gain. It's not a lottery win, but it's the foundation of real wealth, built on discipline and patience. Summary and CTA. The difference between a successful investor and a broke one isn't luck. It's having rules that protect you from your worst instincts, fear, and greed. Building wealth isn't about chasing rocket ships. It's about owning quality assets and letting time and compounding do the heavy lifting for you. You get to choose which path you take. You can chase hot tips and stress over every market headline, or you can calmly build your financial future one smart decision at a time. The path is clear. The choice is yours. Thanks for watching. If you want more no-hype, real-world strategies for building long-term wealth, make sure you're subscribed. And drop a comment below. Which one of these rules is the hardest for you to follow?